Most investors who want gold exposure make the same mistake. They buy a mining company. They think they are buying the metal. What they are actually buying is a construction project, a labor dispute, and a fuel bill. Maria had been down that road before. She owned shares in a mid-tier gold miner. The gold price moved up 30% one year. Her stock barely moved. The company had eaten every dollar of margin on higher operating costs. That experience sent her looking for a different structure entirely. What she found was a business model most investors have never heard of. It is called streaming. Here is how it works. A streaming company does not dig anything out of the ground. Instead, it provides upfront financing to a mining company that needs capital to develop a project. In exchange, the streaming company locks in the right to buy a fixed percentage of future metal production at a predetermined price, usually far below the spot market. The miner gets the cash it needs today. The streaming company gets a permanent low-cost supply of metal for decades. The result is a business that earns gold and silver margins without ever touching a shovel. Wheaton Precious Metals is the company that built this model into an institution. In its most recent reported year, Wheaton generated revenue of $901 million. Net earnings came in at $582 million, up 129% year over year. Its cost to acquire each ounce of gold equivalent was fixed well below the market price, creating a margin structure that most businesses in any industry would consider extraordinary. The reason those margins hold is structural, not cyclical. When gold prices rise, Wheaton captures nearly all of that upside. Its acquisition costs are locked by contract. When gold prices fall, Wheaton still produces metal at the same fixed cost. The streaming agreement does not renegotiate because the commodity moved. Traditional miners face a different reality. Their margins compress when energy prices rise, when labor costs rise, when processing costs rise. Wheaton faces none of those pressures directly. It has outsourced every operational risk back to the miner while retaining the economic interest in the output. That structure shows up in the long-term production guidance. Wheaton is targeting 1.2 million gold-equivalent ounces annually across its portfolio of streaming agreements. That number grows as the projects it financed come online, without Wheaton spending another dollar on capital development. What this teaches any serious investor is a broader principle. The most durable businesses in any sector tend to be the ones that finance the activity rather than perform it. They sit one level above the operational risk. They earn a royalty on the work others do. They scale without the costs scaling with them. Precious metals streaming is one of the clearest examples of that structure in public markets. If you want to understand how to evaluate businesses like this, the Clear framework is the tool we use at Profit by Friday. It scores every position on 5 pillars: catalyst, leadership, earnings, accumulation, and risk-reward. Every Friday, one stock goes through the full framework in the Friday Flash. It is free. It takes 1 minute to read. The link to subscribe is in the description below.